So I've uploaded a spreadsheet and I will ask David to save it later. So what am I doing? What I did from Bloomberg, if you look on the left, you see the Hang Seng Index, the local Hong Kong benchmark. And you see all the component stocks. So over here you see the index weight. So the largest stock in Hong Kong now, HSBC at 11%, feeds all the way down to Cathay Pacific with only 0.25%. So I have the number of shares in the index, I have the share price, and I also added two fields. Volatility 30 days and 30 days implied volatility. So you can imagine the data is 30-day volatility is actually realized volatility. What movement did this stock have in the past 30 days? And of course, implied volatility, generic for on average now, what would be the implied volatility of a 30-day at-the-money option? So it's the second one, the implied volatility, that we of course need to make our dispersion basket. What I actually even need to do is to add it for the indices itself. So what do we see here? In this column, the Hang Seng Index trades at a volatility. Now, at volatility 24.7. And in the meantime, the various component stock HSBC at 31, Hong Kong Exchanges at vol 50, but China Light and Power, the local utility, only at vol 16. You also see they get a problem, because the Link, Hang Lung Properties and some other small companies, they don't have implied volatility. How could that be? Well, most likely because they don't have listed options. So one thing I can calculate, what is the weight of the stocks that have options? So I say if the volatility is a number, so here I do in this column, if the stock has an implied volatility, that means if there's options listed, I want to see the weight, otherwise a 0. So you see that the sum the sum of the weights of stocks that have options is a bit shy of 100%. So how can I make a correct portfolio? If I would buy still the correct weight in the stocks where I can get options, and I do not buy the stocks where I don't get options, then I buy too little options. So what I can do is I can what's called so-called upweigh. So what am I gonna do? I want to buy just slightly more, let's say some 3% in each of my stocks that do have options, so that in the end I still cover 100%. So what am I going to do? The weight, I'm going to do the weight divided by that 96%. I make everything slightly bigger. But the options that, stocks that don't have options, I still trade with 0 weight, because I can't. And then you see I have a coverage of 1. So this method is what we call upweighting. So now I have a basket of stocks that is not the full basket, I just have a less number of stocks. And for each of them I buy a bit more options. So that the outcome is that I have a slightly different portfolio, but it is exactly the size, the coverage is 100%. So what I'm doing, I'm replacing the stocks I don't have and instead of that buy a bit more of the stocks that I do have. So that is for the list of the implied volatilities. I can also look at realized volatility, and that's the final touch to this dispersion. Every day on an individual option I make money. If it's a long option, I make money if the implied volatility that I pay is less than the actual realized that I get. Or I make money on a short option if the implied volatility I receive is larger than the realized I get. So you can imagine that I can look at that correlation number not just from an implied perspective, but also from a realized perspective. So what can I also calculate? I look at realized correlation, because that is defined as the realized volatility of the index squared divided by the average of the realized volatility of my stocks squared. So now that this is my calculation, do I want realized correlation to be as high as possible, or do I want to be it as low as possible? B3 we already had. C5 already had? Nobody? C6? A7? Already had. B1? Next to me? A12? Already had. No. Okay, whatever. So the idea, I am short index options. So I want the realized volatility in the index to be as low as possible. Because I'm short index volatility, so I don't want the index to move. At the same time, I'm long volatility in the stocks. So these I do want to move. So I want the index volatility to be as low as possible. I want the stock volatility to be as high as possible. So ideally, I want my realized correlation to be as low as possible. And that concludes what do we want to do for the assignment. I want you to make a couple of calculations or analysis for me. First, I want you to calculate implied correlation or correlation for the Hang Seng and for the H shares. So how do we go about, that means 1A, I want you to do upweighting. The method we discussed. But there's a second method we could do, and that is as follows. I could also say, for the stocks that do not have an implied volatility because there's no options, I just gonna use realized volatility as a proxy. I pretend that these options I'm able to buy at the realized volatility. So if I do that, I get a slightly different calculation for this version. So one method is upweighting, the other method is pretending implied equals realized for non-option stocks. And also, what I want to calculate, I want to know the realized dispersion. So that brings us to 3. would you like to do a dispersion? And if yes, which index is better? So this is going to be the assignment. So now you notice that by doing that spreadsheet, I actually already provided you quite a lot of information, making the assignment quite a bit smaller. One thing I'm going to do, I'm going to hard copy the weights, I'm going to hard copy all the Bloomberg data. Because if you upload this file from another computer, the Bloomberg link might not work. Copy. Paste special. Copy. Paste special. The same thing we do for the H shares. Copy. Okay, so based on this spreadsheet, you can calculate, okay, just fill in the numbers. What's the implied correlation? And the one difference, of course, in my previous example, I gave all stocks a 0.25 weight. Now it's a bit more difficult because stocks have different weight. So in the end, I use a weighted average, namely, I do 11% times the variance of HSBC plus 9% times the variance of Bank of China all the way down. So it's slightly different, but not spectacularly so. So the assignment, these are the numbers. I will save them or have David save them. I want the implied correlation for the Hang Seng and the H shares based on upweighting and based on pretending implied is realized. I want to know the realized dispersion. And that means that, would you like to do a dispersion? That is, if realized correlation is a predictor for future movement, or sorry, if realized volatility predicts future volatility. That's a big if. And the reason for that, because only then can you compare these two different data sets. So does this assignment make sense? Okay, then if I may do one phone call and afterwards I just talk a bit more about people want to do recap or one small new parameter. Let's do one small new parameter and then I let you go in peace. But I have to do one phone call, sorry for that. Sorry to bother. Is it possible to have the taxi come a bit early? Because I think I'm already bored people to sleep. So I just got to shave half an hour of the class. If that's possible? Yeah, otherwise I'll wait. No worries, no worries. No worries. These slides come from lectures 9 and 10. I just want to talk about a bit of a underappreciated Greek, to say the least. I don't care about it that much either. And that's rho. And what does it depict? Well, assume we live in Zimbabwe. Zimbabwe has the unpleasant, now Venezuela as well. So it's the Z and the W sound. They have a 10,000% inflation. So a year from now, we can expect prices to go 100-fold. So it takes about 1 billion kwaizu to buy a roll of toilet paper. So suppose I need to make a 1-year market in options. So if the current share price is 100, I actually expect at the end of the year we're trading at 10,000. So from that perspective, would you rather own the 100 call or the 100 put? Both of them are at the money. Clearly, because of that massive interest rate, people would flock to buy the 100 call. So what we actually already knew, the interest rate is a determining factor in my option price. Also maybe, how does it work in terms of hedging? We already did that too. If I sell a call, or let's say if I buy a call, I hedge myself selling stock. So if I sell stock, I receive money on my bank account. So if the interest rate rises, that's a benefit for me because I now get a bigger interest rate. So calls tend to change positively if the interest rate goes up. Put options other way around. If I buy a put, I need to hedge myself buying stock. So I have a cash outlay. I need to borrow money or forgo interest to buy these stocks. So if the interest rate rises, that's a negative. So the amount, or the idea is, the rho is just my change in option value if my interest rate rises by a percentage point. And with a percentage point, I mean the rate changes by 1%, from 2 to 3 or 3 to 4, etc. So that's actually quite straightforward. So where do we start? We start simple at a synthetic. Because what is a synthetic? Owning a call and selling a put. We know that call minus put equals future minus strike. So the future itself is the maturity. So actually the future itself is the stock price plus the interest rate. And that interest rate I calculate the strike price multiplied by the interest rate multiplied by the maturity. So I can calculate how much does that future change for a 1% change in interest. Namely, 1% times the strike times the number of days to expiry, as in years. So I'm going to give it one more desperate try. B1, oh no, next to me. B19, C1, B10, already had, C9, B15, B18, B20, C8, B6, otherwise I'm going to try the other one more time. Mathieu already had a turn, right? Yeah, this is new. Konemin? Not him? Jonas already had a turn. Never mind. Okay. I still have the idea that when the Chinese characters show up, people just duck. Okay, let's do this one. So my share price is 120. I own the 100 put, I sell the 100 call, I buy stock. 1 year to expiry, 5% interest, 50 cents dividend. So how do I calculate the rho? The idea, of course, that I put a lot of fudge information on there. Because I'm not calculating the actual level of the future. So I don't really need to know the share price or the interest rate or the dividend. The only thing I need, how much does the future change? So the strike is 100. So if I raise the interest rate by 1%, I take maturity of a year over the strike of 100, and that turns out to be $1. Final point, what's the sign? I'm long the put, negative rho, short the call, negative rho. So therefore the rho of this position is -1. And that's independent of the market price, the interest rate, etc. Early exercise I discuss next week. So it's easy to calculate what's the rho of a synthetic. I just calculate strike 1% maturity. But what I of course want to know is to be able to allocate rho, how much is for the put and how much is for the call. So let's take a bit of a thought. I know that the deep in the money call actually behaves like stock. I'm selling almost 100 shares as a hedge. So a deep in the money call is where the synthetic is, where the rho is. A deep in the money put has a very negative delta, so I need to buy a lot of stocks. So you can imagine that if it's related to interest, so it's related to about that amount that I have in the bank after delta hedging. And I know that the synthetic always has a delta of 100. The absolute delta call plus delta put will always be 100. So I can actually allocate that rho between the calls and the puts, applying the delta. So now I know it's a two-step approach. First, if I know the maturity and the strike, I calculate the rho of the synthetic. And the next step, based on the delta, I would now distribute that between call and put. So for puts, it's really easy. If I would have a higher strike price, that means there's more rho in a synthetic, because I do 1% over the strike. But also a higher strike price in a put means a higher negative delta. It's more of an in-the-money put. So therefore, if I raise my strike, I compare options with different strikes, then a higher strike option having a more negative put delta means that I get even more rho. The effect helps each other. Higher strike, more interest in the synthetic, out of which more flows towards the put. But the call is difficult, because for the call, on one hand, a higher strike price means that I have more rho in the synthetic, but also a higher strike price means that the call is out of the money, so it has a smaller delta. So there, a higher strike price means more rho in the synthetic, out of which the call gets less. So they're conflicting. So if I look at the charts, the one on the right is easy. Comparing the rho of different puts given a certain strike price. That's important. On this chart, I look at, okay, we're trading 50 in the stock. What are the rhos of my different strikes? So with the put, higher strikes means that's just an ever-increasing rho. But with the call, there's some sort of optimum and then it declines down again. So let's investigate a bit. Why is that and where would that maximum be? But one first thing, I would like to emphasize the difference between the two types of charts. So the first chart, rho of one strike with different share prices. So let's do a call. If the share price, so we know the strike is, let's say 100. So here, if the share price is 0, that means that the delta of the call is also 0, because it's a deep out of the money option. On the other hand, if the share price is really high, the call gets all of the delta. I also know that in this case the strike is 100, so if it's 1 year to maturity, that means that the row of the synthetic, the row of call minus put, equals 1. Agreed? So now I just distribute. Really low share price, the call doesn't get any row. Really high share price, the full row of the synthetic goes to the call. $1. So you just get a curve very similar to the delta curve, but just the numbers on the axis are a bit different. And for puts it's the same. So if I look at one option, what is the row at different share prices? Because the row of a synthetic is fixed, different share price allocate that same amount of row between call and put. So the curve is exactly like the delta. So now we're going to do the other one. And let's build a spreadsheet. Row. Okay, so let's assume I have share prices 45, 40, 35, 30, 25, and on the upside 55, 60, 65, 70, 75. These are strikes. Let's make it bigger. See if I can. Yeah, I can add one more line. 20 on the downside and 80 on the upside. So if this is the strike, and let's say the spot is 50, then what is the delta of the call? So if the strike is 50 and the spot is 50, this guy has a delta of 50, agreed? So a lower strike, the 45 strike, actually will have a delta that is above 50. Where does the delta have the most sensitivity? $5 strike difference has a much bigger impact towards your at-the-money options than it has far away. How can I see that? If I look at the delta curve, and if I take a look, suppose I look at a $5 difference in the share price, which is the same as looking at two strikes that are 5 apart, the impact is much bigger than if I would compare $5 share price difference deep out or deep in the money. So if I would apply that into my spreadsheet, then it could be that the delta drops to 40. So if the strike is 45, it's now an in-the-money call, delta 60, delta 40. I look $5 lower in the strike, it becomes more in the money, let's say delta 68, delta 32, delta 75, delta 81, delta 86, delta 90. Makes sense, right? And on the put side, 25, 19, 14 and 10. So just take a look. Does this look like a plausible delta curve? So when I'm plotting the delta of the strikes in the money, delta 90, you see that the biggest sensitivity for different strikes is towards at the money, and then it tapers down again. So if I know the delta of the call, I also know what is the row in the synthetic. Because the row in the synthetic, if it lasts 1 year, is just 1% times the strike. So here I can calculate, for all these different strikes, what's the row. So then I can also calculate what will be the call row. Well, that is the row in the synthetic multiplied by how much does the call get of that. So here you see delta 90, so 90% goes to the call, 20 cents row, 18 cents goes to the call. And now you see my curve. So if I now add the strikes to it, I have a neat little chart. Nee. Remove, edit, plus. Here we go. So here's my chart, and you can clearly see that 50 is my at the money strike, and already the maximum row of my option is slightly before that. Because these two effects, if we look in our spreadsheet, we can see how it continues. First, if I bring my strike from 20 to 25, that means I increase the interest in that synthetic by 25%. My delta decreases just a bit, by 5 point something percent. So you see that I increase the row in the synthetic to a much higher extent than my delta decreases. So you see that the row of my call keeps increasing. But you also see that every time I raise the strike difference by 5, then the impact, my decrease in delta, gets more aggressive because we go towards at the money. But every 5 I change my strike, I add another nickel into my interest. So you see that after this point, from 45 to 50, or even here, I add $5 strike. So I add 5 cents in row to my synthetic. But because we're getting so towards at the money strikes I'm comparing, I'm really taking a lot of delta away. So we get a bit more row in the synthetic, but far less of that gets allocated to the call. So that's the effect, because gamma maximizes at the money, so the difference between strikes in delta, of course, is also most sharp at the money. So that effect makes that the maximum row already takes place prior to the at the money. So oddly enough, the option with the highest row, okay. Yeah, wait. Yeah. Okay, yeah. Yeah, so that's why it already peaks slightly before. So now I think we're going towards the final part of row. This we're gonna skip. Yeah, because I would like to tell one more thing, and that is row relates to interest rate. And interest rate, of course, I always take changes in the future. So I always take it in one breath with dividend. So on paper, buying a put or selling a call means I buy stock as a hedge. If I buy stock as a hedge, I'm entitled to the dividend. So if the dividend is larger, that's a good for me. So in general, the expectation is as follows. If I am row short, that means I expect to own stock, short calls, long puts, so I have positive sensitivity to the dividend. But that only applies if there's one maturity. Because let's look at the following example. Let's do more row. I have the following. See the sticks? Yeah. So my share price is 100. We know that that's actually not that relevant. And we have long call 100. Let's see. And long 2 times call 100 6 months. I'm short 2 times put 100 6 months. I'm short 1 times call 120 1 year. I'm long 1 times put 120 1 year. The dividend, which is to be paid out 9 months from now, is increased. So my questions: 1. Am I row long or row short? 2. Am I happy at the dividend increase? So how do we solve this? The first part is I want to calculate my row. So what is it? Let's put on my computer. Yeah. So it's just a matter, I'm long 2 times a 6-month reversal, and I'm actually short 1 times a 1 year conversion. Actually the dividend we're going to change is paid 3 months from now. So what is the row of a half year 100 reversal? Interest rate half a year multiplied by 1% multiplied by 100. So the interest rate is 50 cents. Buying the call, selling the put means long row. So therefore, if I own 1, my row is 50 cents. So if I own 2, my row here is actually 2 times 0.5 times 1% times 100. So the row of the top side is 1 long. A 1 year 120 conversion. So 1 year 120 strike, how much interest? 1% multiplied by 120. And because we're short the call, long the put, it's negative row. So therefore it's minus 0.01 times 120. So my total row, I'm actually row short. You can also look at it, what's my stock position? Maybe that's going to be question 2. So how do I hedge a long synthetic? By selling 2 shares. How do I hedge 1 conversion, a short synthetic? By buying 1 share. So what's my current short position? Short 1 share until 6 months from now. So now we already see the row is negative. So if the interest rate rises, that's a negative for me. Why is that? Because I have such a longer option, a 1 year conversion, at a higher strike. So that has an interest rate sensitivity of $1.20 for a percent. I am long 2 times a short-term reversal. So each of them has a smaller row. But how do I hedge it? I now am short 2 shares, buy 1 back as a hedge for the longer one. So I'm still short 1 share. That brings us to the question, if suddenly a dividend is increased and I'm short a share, that costs me money. Agreed? So here you see the combination, so I'm unhappy. So here you see the combination, I'm row short, and still I lose money on the dividend increase. The reason it all boils down not just to the row number. If I have only one expiry, row indicates my stock position. If I have multiple expiries, then row is also containing different maturities. If I don't know where my position comes from, I cannot properly say whether a dividend increase will make me happy or sad. And that about covered our last parameter, row, and that also covers today's lecture. I will inform back about next 2 weeks from now lecture. I might need to flip it 1 week. I'm going to check in it. So I'll check in with David as quickly as I can to confirm whether it's the 12th or not. Same applies for the 26th, so we might do a bit of tweaking. With regards to the assignment, that will be at least more than 2, I think it will be 4 weeks to go. I gave it already because otherwise it might be too close on the exam. What is left to discuss? Actually, one annoying topic, which is early exercise. One practical topic with regards to algo and high frequency trading. I want to talk about a couple of strategies that are now traded. One of them, trading ETFs in the US, S&P 500, versus the S&P 500 future. That's at this moment the largest arbitrage in the world, and also quite a profitable. Also talk about things like index arb, and talk about ADR arbitrage between stocks listed in the US and over here, or in London. And in general, that's talking about algorithmic trading strategies. So the vast majority of it will be early exercise, also some are algorithmic trading, and I will leave plenty of time for recap. And I think you've suffered through enough for today. So thank you very much for your attention and patience. And I'll hope to see you 2 weeks from now. I'll confirm